Welcome to our viewers. Today I want to discuss one article from Economic Times which was published on 7th January 2025. Government says India's GDP growth hitting a 4-year low of 6.54% in financial year 2025. And GDP stands for gross domestic product, and GDP equals to C plus I plus G plus in X. C is consumption, I is investment, that is business expenditure, and G for government expenditure on goods and services by the government, and NX is the net export, nation export minus imports, that is equals to net exports. Actually, GDP is a scorecard for a country's economy health, and India's projected GDP now slow down, and now I want to discuss with a depth analysis with a comparative study on China. India's economic landscape is poised for a notable shift, with projection indicating a slowdown in gross domestic product to 6.4% in the financial year 2024-25, a decline from the 8.2% growth recorded in the previous fiscal year. This projection, derived from the first advance estimates released by the National Statistical Office (NSO), marks the lowest growth rate in 4 years. Understanding the GDP projection, the NSO advance estimate are policymakers, especially in the context of framing the union budget. This projection suggests a declaration in economic activity, underscored by a significant dip in growth during the July-September quarter of financial year 24, which stood at 5.4%, which is very low. And if we discuss with sector-wise growth analysis, then first we go to the agriculture, as because India is still now agriculture based country, so agriculture projected to grow by 3.5% in financial year 24-25, a slight decrease from 3.7% growth from financial year 2023-24. In case of construction, expected to expand by 9.1%, down from 10% in the previous fiscal year. Next, real estate and professional services forecast to go by 8%, a decrease from 8.9% in financial year 2023-24. These figures indicate that while there is a declaration, core sectors continue to contribute positively to the economy. Comparative study with India versus China, then China's recent performance, if we analyzed, then we see China's economics growth in 2024. It is targeted to 5%, and late year stimulate the measures and increase export ahead of anticipated US tariffs. Industrial production surged by 6.2% in December, although domestic demand remained same, with modest retail sale growth and rising unemployment. Global standing, if we see the global picture, then as of 2024, China's GDP stood at approximately 18,273 billion, making it the world's second largest economy. In India, in case of India, GDP was around 3,800 889 billion, positioning in the fifth largest economy globally. Which factors influencing this slowdown of GDP? Number one, global economic environment. The global economy is now is not good at all. That is, uncertainty is there, including geopolitical tensions is there, supply chain disruptions there, and fluctuating commodity prices, all of which have ripple effects on emerging economies like India. Domestic challenges is also there. High inflation rates have eroded consumer purchasing power, leading to sub subdued the consumption patterns. Additionally, the banking sector faces challenges with rising bad debts, and NPA percentage is now growing on. Though this year NPA percentage is too lower than the other comparative to study with the previous fiscal year. Investment dynamics. Private investment has shown signs of stagnation attributed to declining investor confidence and policy uncertainty. This stagnation hampers capital formation and long term growth prospects. So, now the government various policies implemented. One policy is monetary policy. The RBI faces the challenges of balancing inflation control with the need to stimulate growth, maintaining high interest rates to curb inflation could further dampen consumptions and investment. Fiscal measures are taken by the government may need to consider targeted fiscal intervention to boost demand, such as increase public spending on infrastructure and social welfare programs, and structural reforms to be taken addressing structural bottlenecks such as labor market, rigidities, and ease of doing business could enhance productivity and attract investment. Now we can conclude that while India's projected GDP growth slowed down to 6.4% in financial year 2024-25 reflects emerging challenges, it's essential to recognize the broader context. The global economy environment remaining complex, and Indian economy, despite the declaration, continues to exhibit realizing in key factor comparatively. While China's growth rate has also moderated, it remains a dominant global economic player. For India, strategic policy intervention and structural reforms will be crucial to navigate this phase and sustain long term growth momentum. When GDP is growing, especially if inflation is not a major concern, workers can find jobs, business can sell more, and the country is generally prospering. And we hope also India shortly remove their stagnation period and will reach GDP percentage, targeted percentage at least 8%. Here it is end and conclude this discussion. If there is any question raised, you can write to the comment box.